current situation, everyone has been rethinking the strategic asset allocation from the most sophisticated sovereign wealth funds to private wealth clients, thinking about how the world has changed and how to access opportunities going forward. We hope to pick on some topics today and have a discussion on what the smartest minds in the room are thinking and how they're approaching the space. For those who aren't familiar with me, my name is Deborah Ng. I'm the Asia region head for Allborn Partners based in Singapore. We're a specialist alternatives advisor, advising over 700 billion in assets for clients comprising of sovereign wealth funds, endowments, foundations, pension funds, family offices, and some of the smartest alternatives allocators in the world. We've been around for quite a long time. 1994 is when we started and based in the UK. But let the panelists today introduce themselves. Kevin, would you start first?
Sure. It's nice to see everybody here. Kevin Bong, Chief Investment Strategist and Head of Singapore for Alberta Investment Management Corporation, 𝐬𝐮𝐬𝐫. We just set up an office here. We're a $160 billion Canadian dollar fund managing assets on behalf of government, endowment, and pension members for the province of Alberta.
Hi, I'm Adam Watson. I'm a partner and co-head of Asia at Partners Capital. Partners Capital was set up around about 20 years ago, initially to manage the capital of the senior founders of private equity firms. But since then, the business has expanded to work quite significantly with small and mid-sized endowments because our clients from the private equity world sat on the investment committees for their old schools or for charities. We run an endowment-style portfolio for our clients with a heavy allocation to alternatives. We have 7 offices across the world and currently manage about $55 billion in assets in total.
Hi, everyone. My name is Bonnie Yu from CDPQ, Caisse de dépôt et placement du Québec. We are a pension fund with an AUM of $300 billion USD based out of Quebec, Canada. We invest across asset classes and serving 6 million Quebecers in Quebec.
Hi, thank you for having me. Johnny Aji. I am the Alternatives Investment Leader for Mercer. We're a global investment advisor covering essentially from public equities up to private equity and venture capital. We currently advise about $150 billion in assets and roughly about $35 billion in discretionary asset under management.
Thank you. Thanks very much. Let's open and set the stage for where we are today. The Goldilocks era has unfortunately come to the end with the following 7 things. 30 years of globalization ended since the fall of the Berlin Wall, 20 to 30 years of remarkable Chinese growth, 4 decades of post-Volcker interest rate declines, the end of energy and food abundance, 13 years of extraordinary monetary policy, a 30-year peace dividend, and a 30-year excess of global labor capital mobility with declining costs of capital and lower tax rates. These were the 7 factors quoted by Future Fund in their seminal research paper that they did regarding, or it was titled The Death of Portfolio Construction, which they published during the pandemic period. Today, I think we wanted to hear from the panelists, how their organizations have changed their approach to asset allocation as a result of these, this regime shift, right, in so many elements. And I thought that, Kevin would be a great person to open us with, because as many of you will know, Kevin used to run the team on the strategy side for GIC. And GIC, I think, published also a paper called Building Balanced Portfolios for the Long Run, and how to incorporate macro resilience into asset allocations. So Kevin, maybe you can share with us, how, with your joining of 𝐸MCO as the new Chief Investment Strategist, what your outlook is and how will your approach for 𝐸MCO differ from GIC versus what you're going to do for 𝐸MCO going forward?
Sure. Thanks, Deborah. There are probably going to be similarities and differences for sure. One thing, occupational hazard for me, I don't believe in the death of portfolio construction. If anything, the importance of portfolio construction is even more than before, given all the uncertainty that we face. The paper that you referenced, and there's no patent on good ideas, thank goodness, or at least we didn't patent it there, so we can continue to use it, and everybody else, please feel free to as well. The two ideas behind coming up with that paper, one was literally to prepare a portfolio for the end of the confluence of all those tailwinds that you talked about, and to try and make sure that we build a portfolio that is a lot more resilient to a whole bunch of changes, whether step changes or kind of long-term secular shifts in the economy. The other was actually, practically speaking, for all of you who are allocators who think about multi-asset portfolios, it was literally to try and match the difference between kind of long-hold assets on the private market side and shorter-hold assets on the public market side, just to be a little bit more thoughtful about portfolio construction and asset allocation. I think that what it really led to was just a slightly more thoughtful approach to asset allocation and the idea of diversification. It's not just about the asset classes themselves, but the macroeconomic environments that drive the cash flows and the discount rates and how you think about the returns that come from each of those asset classes. And that was really, I think, one of the conclusions that we drew from that paper, which is just to be a little bit more thoughtful about that and what it means as a long-term investor, which I think many of us are, or the clients that we represent are as well. What it means to build a portfolio that is macro-resilient for the long term, not just resilient through short-term volatility. And the results end up looking a little bit different. Now, in terms of potential differences between kind of the old shop and the new shop, I suppose on one hand, with the old shop, when we were doing that paper, we were thinking about it purely from an unencumbered portfolio point of view. So purely assets, no liabilities, and how you want to optimize basically the smoothest possible cumulative total return you could get on a portfolio using asset classes. I think with the new shop, clearly our clients have liability profiles, and we represent quite a number of different clients, and they all have different liability profiles. So taking that into account will change the objective function for how we construct the portfolios. You know, the other, I suppose, somewhat cheekily, we're 160 billion CAD, which is somewhat less well over 100 billion than the old place. And so I think the way we think about market capacity and alpha capacity will be a little bit different as well. So we could be a little bit more creative in how we actually want to access returns on the beta side and also on the alpha side.
Okay, interesting. So size is a benefit. Just, you know, I think in the paper it said the macro resilient portfolio comprised of 19% 10-year tips, 21% equity, 15% bond-like infra, 20% real estate, and 25% private equity. Is that the recipe? I know, you know, the mandate is slightly different for 𝐸MCO, but is that kind of the recipe for success?
Yeah, I believe that the usual disclaimer is this is not investment advice. Even though
it's a research paper, you can all
it's a research
look it
paper.
up, yeah,
It's a research paper, and obviously you've read it a little more closely than I have. I actually forgot what those proportions were, but I think it led to 60% illiquids, 40% liquids, which in and of itself I think is something else we need to think about, depending again on the liability profiles of the clients that we represent. I think the underlying principles behind why those proportions came up was because we wanted to find assets that do better through different environments than what we've been used to for the last 40 years. And very specifically, nominal bonds offsetting the risk of equities, nominal bonds having a bit of a tailwind as rates were falling, and equities obviously benefiting from that from a discount rate perspective as well. And there are other environments that we need to think about, lower secular growth, kind of higher real rates, the potential for inflation to be with us for a longer period of time and what that means in terms of eroding our returns as well. And I think those proportions kind of try to compensate for that with some amount of higher growth, some amount of illiquidity, and some amount of emphasis on cash flow, but in real terms rather than nominal terms.
Thank you, Kevin. Really appreciate that. 60/40, maybe the new 60/40 is liquid, illiquids rather than equities.
Not investment advice.
Not investment advice. Bonnie, I just would like to go to you because, being also, a Canadian, acting for Canadian pensioners, 𝐬𝐿𝐴CE has had a much longer, so you're much further along in the journey. What are the key changes that have happened for CDPQ, over the past 3 years?
Well, actually, fun fact, CDPQ, it's 55 years old, same age as Singapore. So in the past few years, I think we went through a few strategic change. So first of all, we globalize our asset allocation. We diversify from our home-based biases. Currently, 75% of our assets are invested outside of Canada across 70 plus countries. So that has been quite a journey for us. We have office in 10 countries. And then I think the second change is the move of from allocation from liquid assets to illiquid asset to alternative. So currently we're approximately 40% in liquid assets and 60% in alternative, including PE, credit, infrastructure, real estate. And the last change, in the past few years, we have committed and decided to invest more in our local economy. Given our dual mandate, CDPQ has actually dual mandate, first generate return for our pensioner, including my parents. Then second is to contribute to the local economy in Quebec. So for example, this year in July, our infrastructure team celebrate the launch of phase 1 of RAM, which is a light rail, brand new light rail network in Montreal, fully electric, fully automated. As an employee of CDPQ and as a Montrealer, I feel extremely proud of our work. And also last month, we also announced that we're going to increase our fund allocation to Quebec-based manager to $8 billion, from now to 2026.
Fantastic, interesting. We've seen this happen as well with some of the sovereign wealth funds in the region where they are investing domestically as a result, both as kind of investing in their local economies, but also in infrastructure, which has a good return stream. And then it also helps them kind of deal with the currency element being non-US, denominated investors, so there's a natural hedge for them. So that's fascinating to hear. Appreciate that. Well, next, Adam, I think in Partners Capital's evolution, and you deal with many sophisticated private wealth clients, and that was kind of the impetus of how you built your business. Strategic asset allocation, I think you mentioned, is designed to serve a purpose, right? To target a certain return with a certain risk profile. Talk us through what work you've been doing in your portfolios and those discussions you've had with your clients, with the trade-offs that you need to take, in this new environment, this new regime.
Sure. Yeah, as you say, Deborah, we have multiple different clients. We have about 250 different underlying clients. So each of them has a different outlook. And if you go to them to start talking about strategic asset allocation, some of them will give you a funny look, not really understanding what that is, because what they talk to you about is how much money they want to make and how much risk they're willing to take. And I think the dynamic between those two aspects has changed a little bit over the last couple of years. Over several decades, portfolios have been compounding at a really good rate. And then people have seen a lot more volatility in these portfolios over the last couple of years. And there's definitely a view that you're wanting to have a greater emphasis on certainty of returns rather than the absolute return level that you might be targeting. And so when we take those interests and needs of our clients and take a step back and think about what that means in terms of how we design asset allocations for them, one of the things that you have typically seen over time is if you're wanting more certainty, lower volatility, you need to look for things like options, and typically in a high volatility environment, the price of that goes up. But we're in a very different environment at the moment where actually the price of certainty has come down a little bit. If you think about real rates at the moment, you can earn something like 2 to 2.5% real rates, which is up about 3% over the last couple of years, despite volatility increasing. So you're in an environment where if you have capital and you're putting it to work in an area where you're receiving those real rates and have assets that are priced in the structure of the returns work above those real rates, then actually the current environment means that you have less volatility about your returns, but you can still make a decent return, whereas previously you couldn't. And then on the flip side of that, you have asset classes where you need to pay these real rates, and they're obviously facing significantly higher headwinds. And so when we think about the asset allocation that we've had with our clients, and if I sort of look at our tactical positioning now versus, say, a year ago, we're migrating probably about 8 to 10% of the portfolio away from public equities towards both liquid credit and private credit, because we feel like you can generate a similar level of return on those assets over the next 10 years, but with a lower volatility profile. Now, the big elephant in the room is one of the groups that has to pay these higher real rates is the government. So there's questions about how long they let this environment go ahead for, but at the moment we think this is kind of a structure which is beneficial for our clients.
Thank you, Adam. That's fascinating, and I think everyone needs to think about what they give up, what they get, what they're willing to stomach in terms of risk. But I think that with the risk-free rate being higher, it's much easier. Johnny, you joined Mercer 6 months ago, and clearly for your expertise in allocating to alternatives and illiquid alternatives. So can you talk us through what your recommended asset allocation for your Asian clients look like at the current moment?
Sure. So let me just round up the earlier discussion that Kevin threw out. And, I think when you did that asset allocation study, that is not too dissimilar compared to a typical asset allocation study for an endowment, right? To give you an example, a typical endowment in the US would probably have somewhere between 50-60% in VC/private equity. Even the private equity is more geared towards the lower middle market, almost like the intersection between private equity and VC. And the driving thesis behind that is that, for the last 20-25 years, venture capital has actually proven to deliver the return on a risk-adjusted basis. Now, that was in the zero rate environment. Now we're in the 5% environment. Now contrast that to a typical asset allocation profile of a pension plan with liabilities, with different maturity profile, and whether or not you still have net cash inflow or net cash outflow. From our survey of more than 100 pension funds globally, the allocation to private will actually shrink to about, say, 10-15%, with about 12-13% being the median, right? Because you have liabilities to make sure that you need to be able to pay. You cannot risk the pension fund to be underfunded. And also, more importantly, your eventual glide path, right, has to be somewhat correct. And that basically gives you some constraints in terms of your asset allocation profile. Now, what is different today is that we're living in a 5%, base rate or risk-free rate environment. So therefore, the original thought process of saying like, okay, I'm not getting anything from my government bond, everybody shifts to private credit because at that time 6-7% looks very good in a 0% world. Today it's even looking better, particularly if you have floating rate, because it's delivering you 10-12%, which basically starts to bump and compete with your other allocation of alternatives. I mean, particularly, for example, core real estate or even core infrastructure, right? Historically yielding about, say, 4 to 5% with a total return of 8. So the argument is that why do you need to take equity risk if you can take a debt-like risk with similar or comparable return? So that is, yes, within your SAA framework, and I do not suggest just because the market environment change, you need to throw away your strategic asset allocation, but within your strategic asset allocation, what will be your dynamic or tactical asset allocation within those different silos, right? You need to tweak it a bit towards the debt instead of towards the equity. Now, having said that, when we talk about private debt, I mean, typically we refer them, as direct lending to typically private equity sponsored, right? But I think private debt has a lot more, it's a lot broader than that. You should actually include, real estate debt and infrastructure debt as well there. So as a general statement, I think that is looking attractive, particularly, compared to other some core returns. But don't forget about, your long-term growth element in the portfolio as well, namely being, private equity and venture capital. And I think if you're able to take the risk, venture capital and private equity is actually looking increasingly interesting. As a case in point, about say 12, 18 months ago, your average entry multiple is probably 12.5, 13, maybe on the outside 14 times. Today you're getting it at about 10-ish. If you're lucky, in certain countries like in Japan, you can even get, low single digit equity multiple, entry multiple, which is very, very attractive. And if you're able to take a bit of currency volatility, okay, maybe it's in your play. Now, another interesting point is that whatever that we're talking about today, right, the whole context is assuming that you're a US dollar-based investor. Now, you put yourself in the shoes of, say, a big Japanese pension plan, or insurance companies, or any institutional investors like that. The increase of base rate from 0 to 5% actually did nothing for them, because the cost of hedging back to Japanese yen increased from essentially, say, 100 basis points to 500 basis points. Now, conversely, if you're like a US dollar-based investor investing in Japan, you get paid 500 basis points to convert it back to US dollar for essentially doing nothing. So, yes, broad picture, that is attractive, but it depends on who you are, where you are, your, base currency funding. There are a lot of nuances around that. So, correct, but be mindful. I guess that's the main message. You cannot adopt, say, one size fits all.
Yep. Johnny, thank you so much. I know that Mercer has a very strong pension fund practice. It tends to be more 60-40, and I guess you've done a lot of education of late, especially since you've joined them. How is that conversation, is it are more investors open to alternatives now? Is that,
Yes,
are alternatives mainstream for when you?
Yes, they are. I think it's probably like a misnomer to call the alternatives, because it's no longer an alternative. I mean, if you're an endowment, that is basically your foundation,
Yep.
portfolio allocation. So that is not an alternative strategy. I think the nomenclature arises from I guess historically from pension fund, whereby their traditional portfolio is 60-40, and then I just chuck 10% in alternatives. That's why you call them alternatives. But I think they're more increasing acceptance towards alternatives. Even amongst, for example, the larger family office clientele, which, if you look at the lower tier around the ultra high net worth individual, the typical profile is that, look, I may be multimillionaire, single digit billionaire, I want semi-liquid product because I want liquidity. Some of them have actually graduated from that and say, look, I slowly understand how I can behave, and given my size, it's comparable to, a smallish type institution. I need to behave more like an institutional investor.
Yeah.
So they can take more privates. So essentially, yeah, it's coming of age, I think.
Yeah. I find that, actually some of the families do already engage with the endowment, the university endowment approach, so they have very high allocation to privates. It is often the corporate or, just the pension funds that tend to be stuck in that, but, it's nice to see that continuing integration. And even previously so-called conservative investors, they're looking at alternatives, be it liquid or illiquid, as just a different form of accessing the opportunity set across equities and fixed income, right? So, but the ability to take on, in their minds, risks, I think, is slowly changing. Yeah, thanks. And so that's music to our ears, but it also means a little bit more competition for capacity in a capacity-constrained world. Thanks for that. Let's, aside from all those 7 top, things that we have come to an end, I think the forward challenge is a 5% world, right? So in a 5% world, which strategies or assets are you banking on or allocating to, to do well? Johnny, you touched a little bit about this, but maybe you can talk about whether, your recommendations more shifting allocations towards debt from equity, and which kind of debt. I know you have a very differentiated view. It's not generic debt. So would you walk us through that?
As I alluded to earlier, right? I mean, you have different silos like your PE, real estate, and infra. If you have core positions, and assuming that you have net inflow still, I mean, you have 2 choices, right? You can rebalance by using your net inflow and allocate it to the respective credit bucket, meaning direct lending in your PE bucket, real estate senior lending in your real estate bucket, and infra lending in your infra equity bucket to reduce the equity position that way. And as I understand it, there are a number of very large institutional investors trying to prune or sell off some of their direct real estate holding as a way to redeploy to either debt or equity, or even, if they have the risk budget, higher returning strategies. So that's one way to do it. But I think the math is still valid today in a sense that, look, if you can get, for example, in direct lending 10 to 12% debt, does it really make sense for you to invest in a, say, large cap equity manager with a projected return of, say, roughly plus minus 15, right? It's a tougher argument to sell. Similarly on real estate and infra, if I can get 6%, 7% return directly lending to direct real estate, why do I invest in a core real estate yielding 5 with plus equity alpha, right? Unless you really believe that, look, I like logistics, 20% annual return, I believe in that for the next 5 years, 8 years, then fine. You can take equity position. But I think increasingly the math is increasingly doesn't stack up, at least in our view. So obviously there are multiple ways to do it, but I think the key thing is in any strategic asset allocation is that, you should not be tempted to say, oh, just because the market changed, I need to throw away your strategic asset allocation. It's being done, exactly for a purpose, right? And obviously it's not set on stone, and you shouldn't keep it in perpetuity, and you should refresh it, ideally every 5 years, right? So you need to balance the tactical decision with the long-term decision. I think that's the key point.
Thank you. I think a lot of people have been looking at private credit because, of the higher risk-free rate and some knock-on effects there. Adam, Partners Capital have been invested in private credit since 2010. What was the impetus behind it, and how do your allocations look like from then to today?
Sure. So I think, as I mentioned, Johnny's been mentioning, private credit looks attractive at the moment, and we kind of saw an opportunity there back in 2010, but for different reasons. The reasons then was essentially financial repression. You're getting very low real rates. So how do you get some premium if you're an endowment which needs some form of yield and you're able to lock up capital? And at that stage, you have sponsor-led deals that you can go into, and there's some opportunities in real estate. But what we saw really between 2010 and I guess 2014, 2015 was the dynamic in the market change. You got a lot more capital coming into the asset class, and that makes you sit back and think about what your options are. One, you can accept lower returns. Two, you can look to lever the returns, which a lot of people did, add leverage onto senior debt. Three, you can move out in terms of the risk you're taking, go into the mezz space. Or four, you can look to try and get some complexity premium. And that was really where we moved our portfolio. So instead of just going into the traditional buyouts, we started looking in two areas. One was structured credit, which still had fewer people coming into the market, and you could still earn premiums there on the supply side. And the second was really looking at people who were lending to alternative assets. So you could be lending against a royalty stream on a drug, you could be lending against some IP in the technology space, and at that stage you could still lend at quite conservative levels at sort of 20% LTV, but get high yields and also get equity warrants in there. So that was quite an attractive space at that point in time. We still think it remains to be interesting, but the sponsor market's really come back. As Johnny was saying, you can get sort of debt at SOFR plus 6.5. So the yield on that in the low double digits is quite attractive. I think the risk that we see in the asset class, there's a few of them. One is if more capital comes in there, which we saw previously, but even more so on the demand side now. If the private equity firms are having to pay double digit on their debt, they're not going to lever up in the same way that they've done previously. So you may actually see the demand for private debt coming back, which creates the oversupply and pricing will come in. So that's one thing to worry about. The second thing is just really we haven't gone through a crisis before where private debt's represented such a large part of the market. And previously, when the debt was held at banks, the banks have really an impetus to come together to lend and pretend and extend and all of that, whereas on the private market, people want their capital back, and the externalities can be faced by other people. So I think while we're leaning into that asset class, we're still being quite conservative because of that potential downside there.
Thank you, Adam. It's a fascinating...
If you don't mind, can I jump into Adam's comment, just to add?
Yep.
Even if I think, Adam, we generally agree that private credit is an interesting space to be in, but again, the different kinds of private credit. Now, I think relatively speaking, right, private credit mezz piece at about 14.5 looks less attractive today in a 5% world compared to a 0% world, right? Because if senior is getting 10 to 12, what do you need to take a mezz position at 14.5? So that needs to be repriced. And I don't think that has been fully repriced yet. Sorry, please.
Great, thanks. I think we're running out of time, so I just wanted to, since we had, Asia-focused specialists here on our panel as well, I really wanted to, bring it back to in the 5% world. What are you guys doing in Asia, right? So maybe, Kevin, I'll start with you. Given your new role at 𝐸𝐸MCO, it could be big picture or, a little bit more granular. I know it's still early days, so tell us how you're looking at opportunities in Asia.
Sure. One of the reasons why we opened the office in Singapore was to add Asia more consciously to our portfolio toolkit as a whole. Our exposure to Asia, we're a lot earlier in our journey than, say, kind of Bonnie with CDPQ, and so it's, call it, 5 to less than 10%, depending on how you kind of measure exposure in the portfolio right now, and it's mostly, infrastructure and developed Asia and some index exposure on the equity side, public equity side. So, the general trajectory, which I think our kind of CEO, Evan, has shared before, is just more. So we're looking to do more in Asia. But we do that for a couple of different reasons. I think historically, the narrative behind Asia has always been one about growth. we know that that picture can be challenged in certain areas, and obviously I think that the general trajectory for global growth is not as strong as it used to be, and I think with Asia that may not be that different as well, depending on demographic trends and a few other things that we could spend all day talking about. But beyond that, Asia would probably be a useful source of diversification for the portfolio because of, again, differing policy cycles, kind of differing economic environments, differing stages of growth and development. And most importantly, I think to our mind at least, Asia is a good source of alpha. There's a lot of diversity and dispersion in the markets themselves. To the extent that we're able to find some of those opportunities with the right partners, we're just looking to do more there. Again, just to build up the portfolio and the toolkit and be able to access growth and returns wherever we can get them.
Great. Bonnie, which strategies are you looking at?
Well, currently our exposure in Asia Pac is 12%. We're still very constructive in the region's growth. So we're exposed to the beta in Greater China region, ASEAN, including Vietnam, and also, of course, India. And then in terms of on the hedge fund side, finally we see some dispersion among the different countries in the region. So we're really looking at maybe deploy more on global macro strategy, but with an Asia-based manager.
So maybe if you're closer to Asia, you'd be better able to weather those macro storms. That's interesting. Thank you, Adam. I know you oversee Asia, and the allocations here. Please walk us through your thoughts.
Yeah, I don't know if you saw when Kevin was speaking, I was sort of nodding aggressively there. I think our views are the same. People have had a misunderstanding about Asia, thinking it's a pure growth story that you play on an equity side. What we've seen is the growth just creates so many dislocations and so much misallocation of capital that you get a lot of volatility, and being able to exploit that through a range of different hedge fund strategies is actually probably a more interesting place and a consistent source of alpha. And then the second point that you're making on diversification, I feel like a lot of people have seen a sort of missed opportunity in Asia because they viewed it purely as a China market. And if you allocate on benchmarks, you end up being so overweight China. We still think China has a role to play in client portfolios, but actually if you look across China, India, Japan, Southeast Asia, these markets are not only decorrelated to global markets, they're decorrelated to each other. So actually by having that broader mix across different countries in Asia, we think that's the right way to play as well.
Yeah, certainly from our client base, I think the focus and looking for alternatives to China has resulted in much more interest in Japan, much more interest in India. It can be hedge strategies, it's long only, it can be PE and VC in Japan. We've seen a lot more activity. So the growth is certainly there, and I think the differential in terms of volume in the market, in terms of volatility, the breadth of managers in Japan still a little bit narrow, but at least they're more increased opportunity set. Thank you for that. I know increasingly, I think partnerships with managers and GPs going forward and building long-term relationships sometimes help with securing capacity and relationships. For the managers and GPs in the room, what do they need to do to get your dollar?
I can start.
Okay, thank you, Bonnie.
Open an office in Montreal or Quebec.
Can I jump in? Well, tell me your secret sauce. Tell me why you're different compared to all your peers in the industry. And please articulate that. And, I know that not every manager is as polished and as eloquent as some of the larger ones, but we'll always give you time to explain what you're trying to do. We'll always give you the airtime to understand what you're doing, because we owe that to our clients. If we don't understand your strategy, we don't understand what you're doing, we're doing our client a disservice.
Thank you, Johnny. Adam or Kevin?
Yeah, just very quickly, I think from our perspective, we very much have an alpha-beta separation approach. Beta, as I said at the start, I think the returns on equity beta are going to be lower than they have been historically. We can access that cheaply, so uncorrelated alpha is what we're looking for in portfolio construction.
Yeah, very similar. Just helping us build conviction in your competitive edge for good inflation risk and obviously kind of cost-adjusted returns for what you do. And you don't need to open an office in Edmonton for us, so comparative advantage for us.
It's harder to get to. Thank you. Thank you, panelists. I just have one last question. I know it says speakers exit to the right. We will do that in a second. But really lightning round. Will the Fed funds rate, and we've seen what's been going on, inflation, interest rates, will the Fed funds rate be higher or lower when we meet here again next year? Kevin, starting with you.
Lower because I have a mortgage to refinance here, so I'm really hoping that that's the case.
I'll go higher.
Thank you.
I think I go the same.
Okay, good. Johnny.
Good question. Probability-wise, it's likely going to be lower, but not by much. Probably at about 50, 100 basis points.
Thank you. I was asked this question on a panel earlier this year, and I just took the forward rate of 5.5%, so that was my expectation. I would like everyone to put a hand together for our panelists and for sharing their views. Thank you very much.